Let me ask you something. Are you aware that 13 states are already showing the same data patterns that preceded every major recession in American history, and that financial institutions are quietly repositioning their exposure while most Americans remain completely unaware of what's building beneath the surface? What we're about to walk through isn't speculation or fear-mongering. This is systematic analysis of hard economic data from the fourth quarter of 2025, showing which states have created conditions where normal economic slowdowns transform into devastating regional collapses. Recent data from the Bureau of Labor Statistics, Federal Reserve economic indicators, and state fiscal reports reveal a pattern of compounding vulnerabilities that makes these 13 states uniquely exposed as we move into 2026. Before we go any further, if staying informed about economic reality matters to you, hit that subscribe button and turn on notifications, because what mainstream analysis isn't telling you could determine whether you're positioned to protect yourself or caught completely unprepared. Here's what the numbers reveal. We're not looking at 13 states with identical problems. What we're examining are 13 different combinations of the same three structural triggers. And when these triggers converge, history shows us exactly what happens. Let me break down the three triggers you need to understand before we examine which states are most exposed. Trigger number 1 is fiscal structural deficit. This isn't about states running small budget shortfalls during downturns. This is about states that entered the current economic expansion already carrying debt loads and unfunded obligations that exceed their ability to respond when tax revenues decline. We're talking about states with pension funding ratios below 60%, debt to GDP ratios above 15%, and structural deficits that existed even during peak revenue years. When recession hits, these states have no buffer. They're forced into immediate austerity that accelerates economic contraction. Trigger number 2 is economic base concentration. States that built their revenue models around narrow economic sectors face catastrophic exposure when those sectors contract simultaneously. We're seeing this in states heavily dependent on commercial real estate tax revenue as office vacancy rates hit historic highs, in states built around energy extraction as transition economics reshape demand, and in states dependent on high-income resident tax revenue as remote work enables geographic arbitrage. The Case-Shiller data from late 2025 shows property value stagnation in key metros, which translates directly to collapsing tax bases in states dependent on property tax revenue. Trigger number 3 is migration reversal. Between 2020 and 2023, 10 states absorbed the majority of domestic migration, with tax revenue models built on assumptions of continued population growth. What recent Census Bureau estimates from 2025 reveal is that this migration is not just slowing, but actively reversing in several key destinations. When population growth that averaged 2% annually suddenly shifts to population decline, the fiscal mathematics change catastrophically. Fixed infrastructure costs get distributed across fewer taxpayers, while demand for services doesn't decline proportionally. Now that you understand the framework, let's break down exactly which states are positioned for the hardest crashes, starting with the locations showing the most dangerous combination of all three triggers simultaneously. Number 1 is Illinois, and what makes this the most vulnerable state in the country isn't any single factor, but the mathematical impossibility of the fiscal position combined with accelerating economic exodus. Let me show you the numbers behind this. Illinois entered 2025 carrying $144 billion in unfunded pension obligations, with a pension funding ratio of just 46%, meaning the state has less than half the money it needs to meet obligations it's legally required to pay. The state's total debt burden sits at 468.7% of annual revenue, the highest ratio in the nation. Here's what makes this especially dangerous. During economic expansion with rising tax revenues, Illinois still ran structural deficits. Moody's downgraded the state's credit rating to just above junk status, and the interest costs on existing debt now consume 8% of the general fund before a single government service is funded. But the fiscal crisis is only one dimension. Illinois lost 344,500 residents between 2020 and 2024, representing both tax base erosion and a shift in demographic composition as higher income, younger workers leave while retirees with fixed incomes and greater service demands stay. Recent IRS migration data from 2024 tax filings shows Illinois lost $9.8 billion in adjusted gross income to outmigration, the largest loss of any state. When recession hits and tax revenues decline, Illinois faces an impossible choice. The state cannot cut its way to solvency because pension obligations are constitutionally protected. It cannot borrow its way through because credit markets are already demanding premium rates. It cannot tax its way out because the residents most able to pay are actively leaving. Cook County, which generates roughly 40% of state revenue, saw property tax delinquencies rise 17% in 2025 compared to 2024, even during economic expansion. Major employers including Caterpillar, Boeing's Defense Division, and Citadel have either relocated headquarters or announced significant workforce reductions in Illinois locations. The Chicago metro area, which represents 65% of state economic output, experienced office vacancy rates reaching 23.4% in the third quarter of 2025, destroying the commercial property tax base that funds municipal services. When recession pressure hits this structure, we're not talking about managed decline. We're talking about a cascade where declining revenues force service cuts and tax increases that accelerate outmigration, which further reduces revenues in a self-reinforcing spiral that Illinois lacks the fiscal capacity to interrupt. Number 2 is New Jersey, and the vulnerability here combines the second highest property tax burden in America, with an economy deeply tied to financial services and commercial real estate, both sectors showing significant contraction indicators in late 2025. New Jersey's effective property tax rate averages 2.47%, compared to the national average of 0.99%, meaning homeowners pay 2.5 times the national rate before considering home values. In real dollars, the average New Jersey property tax bill exceeds $9,500 annually, and in counties like Essex, Bergen, and Union, average bills top $12,000. Here's the crisis mechanism. These extraordinary tax rates were sustainable only because proximity to New York City justified the cost premium for residents working in Manhattan's financial district. Remote work permanently changed that calculation. Recent data from Castle Systems tracking office occupancy in Manhattan shows utilization rates stabilized around 60% in late 2025, with major financial institutions including Goldman Sachs, Morgan Stanley, and J.P. Morgan publicly committing to hybrid models that reduce office space requirements by 20 to 30%. This means the justification for paying New Jersey's tax premium while maintaining proximity to offices that workers visit twice weekly instead of 5 days no longer holds. Census estimates from mid-2025 show New Jersey experiencing net domestic outmigration of roughly 68,000 residents annually, continuing a trend that began in 2020 and has not reversed despite the state's previous stability. What makes this migration particularly devastating for New Jersey is the demographic composition. The state is losing working-age, higher-income households while maintaining or slightly growing populations in older demographics with greater service demands and fixed incomes. This means the tax base shrinks while the cost base grows. New Jersey's pension system holds $239 billion in obligations with funding ratios of just 58%, requiring annual contributions that consume an ever-growing share of the state budget. Total state debt exceeds $210 billion, and debt service costs take 14% of revenues before any discretionary spending occurs. When recession hits, New Jersey's revenue model collapses from multiple directions simultaneously. Income tax revenue, which represents 45% of state receipts, declines as high earners face bonus cuts and layoffs in financial services. Property tax revenue, which funds municipal and school district operations, faces pressure as property values stagnate or decline, while tax rates cannot increase further without triggering additional migration. Sales tax revenue drops as consumption contracts, and the state has no capacity to borrow because credit markets already price New Jersey debt at premium rates reflecting the structural imbalance. Newark, Jersey City, and Paterson already show signs of fiscal stress with rising municipal debt defaults and increasing difficulty financing basic infrastructure maintenance. The state's position entering 2026 is that it needs economic growth to manage its obligations, but the structural factors are producing economic contraction regardless of broader national conditions. Number 3 is Connecticut, and here we're looking at a state that built its entire economic model around financial services, insurance, and high net worth residents, all three of which are actively contracting in late 2025. Connecticut's economy generated $295 billion in GDP in 2024, with financial services and insurance representing nearly 30% of that total, double the national average concentration. The state's tax revenue model depends heavily on capital gains and bonus income from financial sector workers concentrated in Fairfield County, creating extraordinary volatility. In years when markets perform well, Connecticut runs surpluses. In contraction years, revenues collapse catastrophically. Here's what recent data reveals. Connecticut lost an estimated 22,400 residents through domestic migration in 2024, marking the fourth consecutive year of population decline. More critically, IRS data shows the state lost $3.7 billion in adjusted gross income to outmigration in 2023, the most recent year with complete data, representing a 28% increase in income loss compared to 2022. This isn't just people leaving. This is wealthy people leaving. The state's top 1% of earners, roughly 15,000 households, pay approximately 40% of state income taxes, creating a revenue model where a relatively small number of departures creates fiscal catastrophe. Connecticut's fiscal position compounds the economic vulnerability. The state carries $77 billion in total liabilities, including $38 billion in unfunded pension obligations and $22 billion in unfunded retiree healthcare costs. Pension funding ratios sit at just 52%, among the worst in the nation. The state's bonded debt of $22 billion translates to roughly $6,200 per resident, one of the highest per capita debt burdens in America. Debt service consumes nearly 12% of the general fund, and this percentage grows annually as outstanding bonds carry interest rates locked in at levels that exceed current economic growth rates. The trigger for Connecticut's crisis is already visible in late 2025 financial sector data. Major insurance companies including Aetna, Travelers, and The Hartford have announced significant workforce reductions and office consolidations, with hybrid work models reducing Connecticut employment even as companies maintain nominal headquarters for tax purposes. The financial services sector, concentrated in hedge funds and asset management firms in Stamford and Greenwich, faces performance pressure as markets show volatility and client redemptions increase. Wealthy residents who remained in Connecticut through 2025 face declining portfolio values as recession arrives, which directly translates to collapsed capital gains tax revenue for the state. When recession hits Connecticut, the revenue model doesn't just decline gradually. It collapses suddenly as bonus income disappears, capital gains evaporate, and the state's dependence on a narrow base of high earners means even modest migration among that group creates budget craters. The state cannot replace this revenue through broad-based taxation because middle-income residents already face high property taxes and cannot absorb significant increases. Connecticut enters 2026 in a position where it needs market performance and financial sector health to maintain solvency, but both are contracting simultaneously, with no policy mechanism to interrupt the cascade. Number 4 is California, and I want to be specific about what we're examining here, because California's crisis is different in character from the other states on this list. California isn't facing immediate insolvency. What California is experiencing is the unwinding of a revenue model built on assumptions about permanent economic conditions that are proving temporary. California generated $3.9 trillion in GDP in 2024, making it the world's fourth largest economy, but that scale masks increasing concentration and vulnerability. Here's what the numbers show. California's tax revenue comes predominantly from income taxes, which represent roughly 65% of general fund receipts, one of the highest concentrations in the nation. More specifically, the top 1% of California earners, approximately 180,000 tax filers, pay nearly 50% of all income taxes, creating a revenue structure of extraordinary fragility. When high earners face income declines, California's budget doesn't decline proportionally, it collapses catastrophically. We saw this pattern in 2008 when California faced a $42 billion budget deficit as capital gains tax revenue disappeared. Recent data from 2024 and 2025 shows the early stages of this revenue concentration creating crisis conditions. California experienced net domestic outmigration of approximately 343,000 residents in 2024, continuing a trend that began in 2020 and has not reversed. More critically, the demographic composition of this migration is devastating for state finances. Young, high-earning tech workers and established wealthy residents are leaving, while California continues to attract or retain populations with lower incomes and higher service demands. IRS migration data from 2023 showed California losing $29.1 billion in adjusted gross income to outmigration, the largest loss of any state by an enormous margin. The structural driver behind this migration is that remote work eliminated the necessity of California residence for many high earners. A software engineer earning $400,000 at a San Francisco tech company can now perform identical work from Austin, paying no state income tax instead of California's 13.3% top rate, saving $52,000 annually in state taxes alone, before considering cost of living differences in housing, property taxes, and general expenses. Multiply this calculation across tens of thousands of high earners, and you see the revenue crisis building. California's fiscal position entering 2026 includes a projected $68 billion budget deficit over the next 2 fiscal years, according to the Legislative Analyst's Office. The state's unfunded pension liabilities through CalPERS and CalSTRS exceed $170 billion with funding ratios around 72%, better than many states, but requiring annual contributions that consume growing shares of the budget. The state's total debt burden exceeds $500 billion when including bonds, pension obligations, and retiree health care costs. When recession hits California, the revenue model collapses from multiple angles. Capital gains taxes, which were 25 to 30% of revenues during market peaks, evaporate as tech stocks decline and startups fail. Bonus income and stock compensation that forms the majority of high earner income faces, cuts, or disappears entirely. Venture capital activity, which fuels the innovation economy that generates much of California's tax base, is already down 60% from 2021 peaks, according to PitchBook data from 2025. The commercial real estate sector in San Francisco and Los Angeles faces historic vacancy rates, with San Francisco office vacancy hitting 36.7% in the third quarter of 2025, destroying the property tax base that funds municipal services. The state cannot easily cut spending to match revenue declines because ballot propositions and constitutional requirements lock in specific spending levels for education, healthcare, and other services. California cannot borrow extensively because credit markets are already concerned about the structural deficit, and the state cannot tax its way to solvency because the residents most able to pay additional taxes are the same residents actively leaving for zero-income tax states. California enters 2026 facing a crisis where its revenue model requires sustained market performance and retention of high earners, but both conditions are deteriorating rapidly. Number 5 is New York, and the vulnerability here mirrors California in some respects, but with even greater concentration in a single sector and geographic area. New York generated $2.1 trillion in GDP in 2024, but the state's tax revenue depends overwhelmingly on financial services activity and high earners concentrated in New York City. Wall Street and related financial services represent approximately 20% of state GDP, but generate nearly 40% of state tax revenue when including income taxes, capital gains taxes, and business taxes from financial firms. Here's the crisis mechanism. New York's top 1% of earners, roughly 95,000 households, pay approximately 46% of all state income taxes, creating vulnerability where modest migration among this group creates budget catastrophes. Recent data from 2024 shows New York experienced net domestic outmigration of 216,000 residents, continuing a trend that began before the pandemic but accelerated significantly after 2020. IRS data from 2023 shows the state losing $24.5 billion in adjusted gross income to outmigration, second only to California. What makes this migration particularly devastating is its concentration. Manhattan, which generates roughly 40% of all state tax revenue despite representing just 8% of state population, is losing residents at accelerating rates. Census estimates show Manhattan's population declined by approximately 5.3% between 2020 and 2025, with particular losses among working-age, high-income residents. The pandemic proved that many financial services jobs can be performed remotely, and major employers including Goldman Sachs, Morgan Stanley, and Citigroup have all implemented hybrid models that reduce required office attendance. This enables high earners to relocate to Florida, Texas, or other zero-income tax states while maintaining their New York employment and income, paying no state income tax on earnings that previously generated substantial revenue for New York. New York's fiscal position compounds the economic vulnerability. The state carries $446 billion in total liabilities, including $227 billion in bonded debt and $219 billion in unfunded pension and healthcare obligations. New York's pension funding ratio sits around 93%, relatively strong compared to other states, but the annual required contributions still consume substantial budget resources. Debt service takes roughly 6% of the state budget, and this percentage grows as the state issues new debt at current interest rates while holding legacy debt at lower historical rates. The commercial real estate crisis in New York City creates an additional dimension of fiscal pressure. Manhattan office buildings that served as the tax base for municipal operations face fundamentally changed economics. Recent data from late 2025 shows Manhattan office vacancy rates at 18.3%, with Class B and C properties showing vacancies above 25%. When major tenants renew leases, they're cutting space requirements by 30 to 40%, and some are not renewing at all, instead maintaining minimal satellite offices or going fully remote. This translates directly into collapsed property values, which feed into reduced property tax assessments, which destroy the revenue base for New York City's budget, which in turn requires increased state support at exactly the moment when state revenues are contracting. When recession hits New York, the financial services sector faces multiple simultaneous pressures. Trading revenues decline as market volatility spikes. Investment banking fees collapse as IPO and M&A activity freezes. Asset management faces client redemptions as individuals and institutions pull capital. Private equity and venture capital deal flow slows dramatically. And bonus pools, which represent the majority of high earner income and thus state tax revenue, get slashed or eliminated entirely. We saw this pattern in 2008 when New York's tax revenues collapsed by 30% in a single year. New York cannot easily replace this revenue because the state's non-financial economy faces its own pressures. Tourism remains below pre-pandemic levels, with international visitors still down 25% from 2019. Retail and restaurant sectors that depend on office workers and tourists continue struggling with reduced foot traffic. And middle-income New Yorkers already face some of the highest combined state and local tax burdens in America, limiting the capacity for broad-based tax increases. New York enters 2026 dependent on financial sector performance and high earner retention, but both conditions are deteriorating as recession conditions develop, and geographic arbitrage makes New York residents increasingly untenable for mobile high earners. Moving to number 6, Louisiana faces a distinctly different crisis centered on energy sector concentration and climate-driven insurance market collapse. Louisiana's economy remains heavily dependent on oil and gas extraction, petrochemical refining, and port activity related to energy exports. Recent data from late 2025 shows oil prices declining from peaks above $90 per barrel to levels around $72, squeezing the profit margins of extraction and refining operations. More fundamentally, the long-term transition away from fossil fuels creates structural uncertainty about Louisiana's economic base over the coming decade. But the immediate crisis for Louisiana is the property insurance market, which has entered full collapse. 7 major insurers withdrew from Louisiana's homeowners market in 2024 and 2025, leaving roughly 40% of properties covered only through Louisiana Citizens, the state-backed insurer of last resort. After Hurricane Ida in 2021 caused $36 billion in losses, and Hurricane Francine in 2024 caused additional significant damage, private insurers concluded Louisiana properties are uninsurable at rates residents can afford. When recession hits and Louisiana needs to support its residents and economy, the state will simultaneously face potentially catastrophic hurricane losses with no private insurance market to distribute the risk.